Well, greetings and salutations, test takers. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. We're working our way through a podcast series on the SIE exam. And my motto is never let the perfect be the enemy of the good. So we're actually doing these on the fly, live recordings each week until we get through the entire exam. This is episode 6, Trading Securities. When we're done, I will check the chat, and I'm more than happy to answer any questions you may have about this particular podcast or a particular NASA or FINRA exam, any exam. And then what I typically do is edit that after we get through whatever we're discussing. So this is going to be on trading, and this is section 3. We're doing it in the order of how testable the content is on the actual exam. So we started with section 2, understanding products and risks, and now we're on section 3. And this is 23 questions, not all on trading. Next episode will be customer accounts, but we're going to be knocking out trading. We're trying to keep these down to, 30 minutes or so you can access them in an audio version while you're driving or working out or whatever you happen to be doing. They're available not only on the YouTube channel, but they're available on Spotify as well. All right, so let's get started in testable content as it relates to trading on your SIE exam. One thing you're held accountable for is to be able to distinguish between the primary market and the secondary market. Trading is about the secondary market. The primary market is where we do primary transactions. Primary transactions are where the issuer receives the proceeds. That's a primary transaction. All those transactions together called the primary market. That's a future podcast episode on, 33 and exempt transactions, safe harbors from 33, like Reg A, Reg D, Rule 147, that kind of stuff. Today's focus, we're going to be talking about trading, and trading is about the secondary market. In secondary transactions, the previous owner receives the proceeds. And on the SIE exam, they do have questions where they ask you to recognize which of the following is a trade that takes place in the secondary market, or which of the following would take place in the primary market, questions like that. So it's important you kind of know that distinction. I kind of think a good analogy is the art market. The primary market for art, the artist is receiving the money. Gauguin is not receiving $50 million. Gauguin, the artist, received $20 from some tourist in Tahiti. The previous proceeds are going to the previous owner. Just saw Picasso traded yesterday in the secondary market for $140 million. Wow, crazy. Okay, so that's the distinction between the primary and the secondary market. Now, in the secondary market, we also have transactions in the secondary market that take place in what we call the third and the fourth market. These are recognition questions on the SIE exam. And so again, these are second transactions, but secondary meaning the previous owner receiving the proceeds. But third market transactions can best be characterized as, test question, listed securities traded over the counter. If I'm not a member of the New York Stock Exchange, I've never agreed that I'm going to trade stocks between 9:30 and 4 o'clock. And if I'm not a member, I can trade them anywhere. So this is basically a New York Stock Exchange listed stock being traded over the counter. Again, these are aim and shoot, point and click recognition questions. Fourth market can best be characterized as direct trading between institutions. So let's say that T. Rowe Price has 1 million shares of Tesla, and they want to sell that 1 million shares of Tesla. And Fidelity wants to buy. Both those are institutional investors. They should we call Dean, our broker, and put him in the middle so he can charge us a commission? He said, no, let's just do it directly. Instinet stands for the institutional network, and that's a system that allows them to trade amongst themselves, so to speak. Now, the two major market centers are the New York Stock Exchange and NASDAQ. The New York Stock Exchange, in 1792, there were no electronics, there were no telephones. If I'm talking to George Washington, who was involved in the IPO, the initial public offering of Bank of New York is older than our country. And George says he wants to sell his stock. And I say, well, George, I haven't been able to find you a local buyer. Are you familiar with one of the most successful cartels ever created, the New York Stock Exchange? He said, well, I am. I said, well, they have an auction every day. Test question. Exchanges can best be characterized as auction order driven markets. And I'm not a member, so we're going to have to go through one of those members, and they're going to charge us a commission. So the New York Stock Exchange is matching buyers with sellers and taking commish. I think, again, in the art market, the analogy would be Sotheby's and Christie's. Those are art auction houses. They don't have art in inventory. They're simply matching buyers and sellers and taking commissions. Apocryphal about how this got going. But, I say, hey, guys, 1792. I say, hey, guys, I've decided I'm going to specialize in providing liquidity in Bank of New York. I'm going to be a specialist or designated market maker in Bank of New York. Why don't you leave your limit orders with me? And if I can get your customer his price or better, I will do so. So that's an auction order driven market. The other major market center, by the way, the New York is the model for exchange markets of all kinds. Over-the-counter markets are negotiated quote driven markets. The major over-the-counter market for stocks is NASDAQ. But lots of things trade over the counter. In the 1850s, there are no electronics, there are no telephones. And one of my favorite locations in San Francisco, where I spent a lot of my career, is the corner of Montgomery and Jackson. And it has a black brass plaque outside. It says, William Tecumseh Sherman was a market maker here. In the 1850s, he provided liquidity in mining stocks. He would turn your money into a mining stock or your mining stock into money. And what you would do is go into his office, and over the counter would be a chalkboard. And the first job you would get as a brokerage firm in those days was called Chalk Boy. And your job is to climb up on the chalkboard and change our quotes. And so you look over the counter, you'd see the quote. It'd be a bid and an ask, a price at which Billy is willing to buy the stock into his inventory, and a price at which he's willing to sell out of his inventory, the bid and the ask. And if you like that quote, you don't have to do business. You can walk down Montgomery Street, look at the other chalkboards and see what those quotes are. And as a seller, you can get the low price, but you want the highest of the low. I'll link to my lecture on bid and ask and trading securities for more in-depth discussions of what we're doing in this podcast episode. But if you like the quote, you give him the money, he give you the security over the counter. Or, if you have the security, give them the security, gives you money over the counter. Now we're all linked telephonically and electronically. And so that's what NASDAQ is. NASDAQ stands for the National Association of Securities Dealers Automated Quotation System. Quotation system. So if I'm a market maker, you're an order entry firm, you don't have inventory in the security, and you call me and say, Dean, what is your quote? I say my quote is 15, 16, 10 by 10. 15, 16, 10 by 10. That means I'm willing to buy 10 round lots into my inventory at 15, and I'm willing to sell 10 round lots out of my inventory at 16. The 10 by 10, that's 10 round lots of 100 shares. That's called the size of my quote. So that bid and ask is from the market maker's perspective. I think a good way to get this straight is whenever a customer is looking at two prices, the customer always pays the high price, always receives the low price. What's that called? The securities industry. That's called the spread. Now, if I don't honor that firm quote, test question, that's called backing away. On the SIE exam, you might encounter a question where they say a market maker fails to honor a firm quote. This is a prohibited practice and is known as, and you got to come up with backing away. Now, my minimum obligation is 100, but if I'm giving you size or displaying size, I would have to honor that as well. Not every firm make markets. Some firms that don't make markets, we call them order entry firms. For example, Schwab doesn't have securities in inventory. So if you're a Schwab customer and you want to buy an over-the-counter security, NASDAQ or any other over-the-counter security, on your behalf, Schwab is going to get that from a market maker. The preference market maker for Schwab order flow is Citadel. What I mean by a preference market maker is Citadel has paid Schwab to send all of their customer orders for NASDAQ securities to them. And they've agreed that they will always honor whatever the inside market is, the highest bid and the lowest ask. Now, on the confirmation you get from Schwab, it's always going to say Schwab acting in its broker agency capacity. We always have to disclose test question capacity. We do so on the confirmation. Now, Morgan Stanley makes markets. They may make a market in the particular security you as a Morgan Stanley customer want to buy. And that would mean you'd pay 16 and no commission. We can't be a broker and a dealer in the same trade. And that confirmation from Morgan Stanley would say Morgan Stanley acting in its dealer principal capacity. A good memory aid device here is ABC, agent, broker, commission, and then DIPM, dealer inventory principal markup or markdown. Again, this is a podcast series. If you want to dig a little deeper with a chalkboard, a whiteboard, and watch me do quotes and things like that, I will link that in the video description for you. We can never be a broker and a dealer in the same trade. So, usually we're going to pick, right? As hey, here at Goldman Sachs, we're a broker-dealer. Some transactions we do with you will be acting in our broker agency capacity. Other trades will be acting in our dealer principal capacity. We'll always disclose what capacity, and we'll never be a broker and a dealer in the same trade. I mean, how could I act as your agent in negotiations with myself about a markup? That's, impossible. So that will be disclosed on the confirm. All right, let's move into the orders and strategies that you're held accountable for on the SIE exam. There's only one order that has no qualifiers, no contingencies, and that is a market order. The market order is the only order that has no qualifiers or contingencies. I want immediate execution, best available price. I'm demented. I sometimes get aggravated because, people outside of our industry don't understand sometimes a market order. I'm saying, listen, it doesn't matter what you're going to charge me. I need it now. So, it is what it is. Just give it to me. Now, I think a lot of people think, again, there's a whole bunch of different types of orders, and there's not. The only two types of orders are market orders, that's it, and limit orders, that's it. Now, you can add a zillion qualifiers or contingencies to an order, but at the end of the day, it's either a market order or our second type of order is a limit order. Now, in a limit order, you're saying you want to do business, but only at your price or better. In fact, right now, just let me pull up a quote. Here is a quote. I'm just punching up on my smartphone. My smartphone has a level 1 NASDAQ data feed, which means it just shows me the inside market, the highest bid and the lowest ask. Right now, Apple's at 183.80. So if I don't really care too much about the price, I just tell my broker, buy 1,000 shares Apple at the market. Now, I'd be accepting that, I'm going to pay somewhere around 183.80. But as a buyer, maybe I tell my broker, I say, hey, listen, I want to buy 1,000 Apple today on a limit of 182. If I can't buy Apple for 182 or less, then I don't want to buy it. Now, if I don't add a time qualifier, the assumption is if I don't buy Apple today at 182 or less, then we just start fresh tomorrow. P.S. You would want to put that buy limit below. I mean, there's no reason to put in a buy limit on Apple at 184 when it's at 183.80. It is very testable to know where we place orders in relationship to the current market price. That's going to be more testable if you're moving on to a 7, but, in general, I would know you place buy limits. Sell limit. I tell my broker I want to sell. I want to sell Apple at 184 or more. There's always an implied or better. And my broker says, well, right now it's 183.80. I go, I know. There's a chance again I don't get my price. Nobody has to do business with you at your price or better. So a limit order, you're more interested in price than you are execution. And again, the point is you may not get a report. We have a stop loss order. There are other uses of stop losses besides stopping losses, but that's the major reason to use a stop loss, right? We either are going to have a long stock position, which means we're bullish if we are long the stock, or we're going to have a short position. We're selling borrowed stock, and that means we're bearish. So if I tell my broker, I say, listen, buy 1,000 shares of Apple today at the market. He calls me, he says, Dean, you bought the Apple at 183. I said, ooh, that's a pleasant surprise. I say, listen, I don't want to lose any more than approximately $3,000. So put in a sell stop at 180. If Apple trades at or through 180, then pull the trigger and make it a live order. Now, a stop order is a contingent order. It may never, ever become live. Part of successful investing is letting your flowers bloom, but more important, pulling the weeds. And a stop loss order is an automatic weed puller. I'm saying stop that loss, stop that bleeding, right? Now, that's what I would place if I'm long. So if I'm long the stock, I'm going to place a sell stop below the market where I'm trying to, again, stop that loss. Again, on the SIE, it's pretty straightforward. If you're moving on to a 7, then we talk about how to use it to protect a profit, how to use it to establish stock positions. But again, the first leg of your testing journey is pretty basic on both, types of orders and option strategies, things like that. Now, if I'm short the stock, so I call my broker and I say, listen, I want to borrow 1,000 shares of Apple. I want to borrow 1,000 shares of Apple. Now, whether I want to borrow money from my broker dealer or borrow securities from my broker dealer, I need a margin account. And they said, well, Dean, let's call stock loan and see if perhaps we can locate 1,000 shares of Apple. Let's see if we have a customer who has signed the loan consent form and said it would be appropriate to lend their securities. We need their permission. And they say, Dean, we were able to locate 1,000 shares of Apple. I said, well, I think, they got problems in China. They got problems on Christmas. Sell short. I'm selling borrowed securities. Now, most businesses, when you sell things you don't own, it's called fraud. But not on our business. I'm selling borrowed securities. I have an obligation to give back at some point those securities. The problem with selling short, you probably heard that. Don't sell that person short. That means they might bite you in the butt and surprise you, and they may go up in value, right? There's a finite supply of stock, potential of the demand. So, if I sell short and I'm wrong, I could lose unlimited sums of money because I don't know what's going to cost me to give back the borrowed Apple stock. So I tell my broker, I say, listen, put in a buy stop at 186. If Apple trades at or through 186, send me home. And please note, I'm placing that buy stop to stop the loss above the current market price. Now, these orders never become triggered or live or elected unless there's a trade at or through. In this case, whatever I said, 186 or 185, at or through. So you got to recognize this idea that it's a contingent order. Now, if you want, when we pull the trigger, you can make it a market order. That would be the smart thing to do, to stop loss. But if you want, we can pull the trigger if it becomes live, and it could be a live limit order. And then I'd say, well, that's kind of foolish because now you're telling me, you only want to get out of the position if you can get your price or better. But if customers want to do foolish things, we let them do so. But I would be familiar with market orders on the exam, immediate execution, best available price. I would be familiar with limit orders, a buy limit below the market, your price or less, a sell limit above the market, your price or more. I'd be familiar with stop loss orders and how we use them to stop losses. In long stock positions, we use sell stops. In short stock positions, we use buy stops. So as we said, sell stops are used to stop a loss on a long position. Buy stops are used to stop a loss on a short position. Now, I really believe in over-learning on your SIE exam, particularly if you're going on to the Series 7. So as I mentioned, I will link some appropriate video lectures that are, a little more in-depth on these things where I show you sequence of trades, I show you examples, I work problems with you. Again, that's beyond the scope of this podcast episode. Now, all orders are considered day orders unless you tell me differently. So, I had a customer one time, he put in a buy limit on 1,000 shares at 18, and it didn't go off. There was never a trade at 18 or lower. And so I called him Tuesday to re-enter it, Wednesday, Thursday. He goes, Dean, are you literally going to call me every day? I say, I am. I said, but listen, if you make it a GTC, good-til-cancel, then I won't bother you anymore. He said, okay, Dean, buy 1,018 GTC, good-til-cancel. Now, typically, the person that would be holding this limit order is what we call the designated market maker in the New York, and he likes to clean up his order book in April and October. I wouldn't worry about that on the SIE, but, the point here is you don't properly renew them. At some point, they will come off that. Very testable, discretionary versus non-discretionary. So as a broker, you may or may not have discretionary authority on the account. It's testable to know the distinction between discretionary orders and non-discretionary orders. I think the way to get these right on your exam is the 3 A's. Action, asset, amount. Action, asset, amount. You can literally, on the question, go through and look for action, whether to buy or sell the security, asset, which security to buy or sell, and the amount. If the 3 A's are present, it's an acceptable order without discretion. It's not a discretionary order. For example, I tell my broker, buy 10,000 shares of GE at whatever time and price you think looks good. So we go through that order. Let's look and see if you need discretionary authority to accept this order. Buy, the action is present. Asset, GE is present. The amount, 10,000 shares. The 3 A's are present. That is not a discretionary order. It is not discretionary to give you authority to do it at whatever time and price you think looks good. That's called getting good execution. Let's say I try it again. I have a jumbo CD of 100 grand coming due. Buy me $100,000 of whatever utility stock you think looks good. Action, buy. Amount, 100,000. Asset, I can't accept that unless I have discretionary authority. So for me to make a decision about 1, 2, or all 3 of the A's, I need to have discretionary authority. That discretionary authority is in written form, and it's before I do the first discretionary trade. So this discretionary account is going to have to be approved by a principal before I start exercising discretion. Solicited versus unsolicited, very testable. I had a client, this was my idea. I said, what I think we ought to do, Mark, is sell 10 of these 75 puts. If I'm right, the puts will expire and we'll get to keep the money. And that was my idea, and that's what happened. And, he likes it. He got to keep like 13 grand, so now he's excited and calls me and goes, hey, Dean, I found one. We could sell 10 of these 240 puts, for 20 grand. And, if the stock's 240 or higher, I said, well, Mark, that's really foolish. I mean, you're agreeing to buy 1,000 shares at 240. That's 240 grand, my friend. And the scenarios are completely different. So, that's going to be unsolicited. Solicited means my idea. Unsolicited means it's the customer's idea. And needless to say, we should not mismark positions. It's my idea. One that, was a little different. Think about this. So I call you up and I say, hey, listen, I know I have discretionary authority, but I'm not comfortable in exercising my discretionary authority in this particular idea. So I'd like to share it with you. And with your permission, I'd like to proceed. I share it with you. You say, let's do it. So that would be solicited, discretion not exercised, right? So solicited means broker's idea. Unsolicited means customer's idea, right? And then again, you make sure we don't mismark the position. All right. Well, I'm trying to keep these episodes in at, a little between 15 and 30 minutes. And it looks like I've been successful in doing that. Remember, inch by inch, your SIE is a cinch. Yard by yard, your SIE is hard. And I will see you for our next episode, which is Customer Counts, episode 7. I am now willing to check out chat and answer any questions you may have. So let me do that presently. Let's see. Wow, Mark, that's a long one. Don't want to interrupt the flow, but I wasn't sure how to contact you directly. You can contact me at Dean the Series 7 Guru at gmail.com. I think I might actually have that as a banner. Let me see if I have that as a banner. There we go. So you can send me an email, Dean the Series 7 Guru at